Hello traders, this is John Kicklighter, Chief Strategist for DailyFX.com, here with your FX market wrap-up for this past trading week, and an outlook for what we can expect in the currency and capital markets in the week ahead. This past week was one of initial incredible volatility, especially when we're looking at particular areas like the big drop-off in equities, the big moves from the yen crosses, as well as the emerging markets, which were the perhaps biggest story of the week. But in the second half of that week, we also had a moderation of activity, though we did have some interesting developments, particularly when it came to the dollar and specifically the Euro USD. Some changes we are seeing, certainly, and there's still a lot of opportunity going forward into the coming week to see these big underlying themes take hold. And the things that I'm looking for are one of two major themes: risk trends or relative monetary policy. Now, in terms of risk trends, the S&P 500 sums it up very nicely by itself. We did have that tremendous decline through the end of the previous week, and then obviously this past week, did see a set of consolidation. Now, an interesting thing about this consolidation is yet while we have had a pullback and while we have seen the market stall out, we have not seen volatility specifically taper off. Now, as has been the case with volatility in the past, when we have pullbacks, even when we are still in those pullbacks, we typically see volatility will drop off relatively quickly. When there is a level of congestion, what ends up happening is there are specifically options traders that will go and sell those options, trying to get the premium that they offer, right? Because they are inflated because of uncertainty. Well, what we're seeing now is that these same, as we call them, vol sellers, are not coming as readily. We see that these volatility readings, and we can see here across the different asset classes, are holding up relatively well, and that is something to be concerned about. All right, we should not necessarily have to see a bounce in the capital markets, whether we're talking about the S&P 500, whether we're talking about high-yield currencies or high-yield junk bonds or whatever it might be. Typically, when the markets stop moving, we should see a natural collapse in these volatility measures. That's not happening. And at the same time, we're not getting a bounce back in these usually springy benchmarks like the S&P 500. This is, in summation, a very good signal that risk aversion is, while not crowding out the rest of the headlines, is a very prominent risk going into the coming week of trading. All right. And as we've discussed before, there are levels of risk that we need to watch for. As we increase up the scale of severity for risk aversion, the market impact becomes greater. We are seeing a relatively high level and sticky level of volatility, and we're seeing a greater level of correlation between things like the yen crosses, the S&P 500, riskier fixed income. Those kind of correlations put us right here on this curve. Now, I know we've been there this entire past week, but staying there is an interesting thing. This is kind of like an RPM measure on your car. You step on the accelerator and it revs up, right? But it usually goes right back down, at least in a bull market. Seeing it stick and the idle go up, that's a concern, all right? But we'll keep our eyes on the different benchmarks we can watch to see where it is on that scale, what different asset classes it actually impacts. Emerging markets will be one of our top concerns going into the next week. And then, of course, we'll also look at the yen crosses and the high-yield assets, and moving on to the commodities and whether there is a global equity move, and then we can get into more severe situations. We won't cover them too much in today's video because we'll probably have plenty of time to talk about it should it get that severe. But our immediate concerns, all right, for measuring this: first, emerging markets. The emerging market MSCI, emerging market ETF that you see here, and its subsequent volatility index, you can see that we are still near the lows of its kind of wedge pattern that we have going back to the middle of 2011. Volatility is still, just like with equities, elevated. When we flip this upside down, not a surprise, volatility is going to be a measure of fear, and fear usually picks up when the markets are selling off. So we do have a pretty straightforward negative correlation between the index and its ETF value. So we'll keep an eye on this in terms of how the ETF, the emerging markets themselves measured in this ETF actually performed through this past month. I actually decided, since it was the end of January, we're going to take a quick look at the performance of these various assets. Well, here's the emerging market ETF, and you can see it was the biggest drop that we've seen from this index since back here in May of 2012. All right, so that's a pretty substantial decline. However, it has not cleared the kind of trend that we would want. Though we have seen an increase in participation. In fact, we just recently saw that there was the biggest outflow of capital in just a span of a week that we have seen on the ETF's short history or short record. That's about 11 years. So a very big withdrawal of capital from the emerging markets. That is the riskier of the asset classes. Now, if you don't want to just look for the MSCI emerging market ETF, you can also look at some of the currency pairs we already trade. The dollar-ZAR is a great one. You can also look at the HKD, any of the emerging market currencies. Now, of course, we'll also be talking about next week, more than likely, the Argentine peso. We'll be talking about the Colombian currency. We'll be talking about the Chilean currency. We'll be talking about a very wide breadth of different emerging market currencies. But this is going to be a measure of capital flow. All right. Now, while we can look at different indicators that can spur the emerging markets along, and there's plenty. We have Chinese data like the service and manufacturing activity reports, but we also have Indian manufacturing, Russian manufacturing. India and Russia are very well-known BRIC currencies, as we call them. We have the Philippines central bank rate decision. Now, you might say, why am I looking at the Philippines currency? Why would I be looking at the Argentine peso? All right. That measure can certainly very easily stoke concerns about general emerging markets. All right, so we have to keep it in our periphery. We'll also have a updated Indonesia GDP figure in the Indonesian rupee, just like the Indian rupee, was a big concern back in August of this past year. It can easily become a problem going forward. We have Brazil with currency flows that we'll be watching because that is a direct measure of the uncertainties there. And we also have, a little bit later on in the week, actually towards the end of the week, the Indian GDP figure. All right, so there's a lot going on for the emerging markets in terms of data, but we're more concerned about how the sector is performing as a whole. So look at the dollar-ZAR, the dollar MEX, all right, all those currency pairs that we watch from the emerging markets. But think of it in terms of how it impacts risk trends. All right, it is the first step of risk. When we get when it moves up to something like the more benchmark SP 500, when it starts hitting the yen crosses more aggressively, when it starts even impacting treasury yields, where the markets start to go to treasuries because they need ultimate safety, that's when things are really starting to come to a head. That's when we're going to hit the kind of sentiment that can force breaks. All right, and if we get a break in trends, risk trends, I will be watching the S&P 500 very closely, because if we can break this former resistance as new support and move to the downside, it would be the indication of a much bigger trend on hand. We'll also be looking at the Asia equities, which the Nikkei 225 actually ended below its own trend line. The FTSE 100 for a representation of European equities. We're looking at these in conjunction. All right, because the broader the influence across the different markets, just like the emerging markets, the more prolific the move is in sentiment. And then, of course, when we get into the yen crosses are looking exceptionally interesting. I'll be watching these very closely into next week. Now, of course, if you want to play a move to the downside with some level of follow-through, medium or long-term, you need a strong push towards risk aversion. That's your best bet for seeing momentum in these particular pairs. Now, I know that these currencies are generally overbought over the period of time that we've seen it rally from around the third quarter, fourth quarter of 2012, and the big stimulus-based move that we've seen, the drop in the Japanese yen or the rise in the yen crosses. This puts it into a position where it is technically overbought. All right, we have also seen that the markets have started deviating off of expectations because the recent data that we've had from the Bank of Japan has actually suggested that we are reaching that inflation target, and the impetus, the drive for more stimulus is actually easing back a little bit. All right, this is perhaps a little bit concerning, and even if we do go to a stimulus move, it's not likely to happen until April. All right, so will there be a big risk aversion theme kicking in before the Bank of Japan can move on its monetary policy? That's the question that people will be asking, and it's unlikely that they would. All right, they would probably have to be forced, physically forced, to up their stimulus program. All right, so that would have to first denote that we have a risk aversion theme, and we would see the risk aversion theme play through before we get the secondary impact from the Bank of Japan. So watching the dollar yen, all right, this is going to be a interesting pair because you can see we have something of a, not to the T, but nice triple bottom here. And a break to the downside would offer up a good signal as long as I have risk aversion. This is particularly important for the dollar yen because the dollar itself is a safe haven, all right, and it can compete with the yen on that level. Now, of course, if the yen crosses are dropping across the board because of risk aversion, then that general move for the yen crosses will carry over to the dollar yen. Far more interesting and an immediate interest for a trade perspective for me is going to be the euro yen. All right, this one is starting to test gravity. It's starting to accelerate to its downside. More of a move of the euro, which we'll look at in a second, but certainly clearing a lot of the technical cues that we have to the downside. Why haven't I taken this trade, you might ask? Well, one, because I'm not necessarily that confident in risk aversion because it hasn't made its break, but two, I'm also short the euro USD. So between the euro USD and the euro yen, these two currency pairs are actually showing a high correlation. I don't want to take the same trade twice. And I know it's a different currency pair, but it's based upon the same factors. Drop off in the euro and risk aversion. It's subtle now, but it could certainly build up to risk aversion. So I have not added this pair to my account just yet. Now, if risk aversion kicks in, completely different story. If I see the SP 500, I wouldn't necessarily mind that I have two of the same trade because it would be a encouraging and very influential trade. Pound yen is perhaps the better placed one from a technical perspective. If we have risk aversion, pair nicely with a break of this descending trend line, that would be a spark that supports the bearings, right? A spark that looks like it has the fundamental follow-through. Keeping a close eye on this one. Actually, I went to considerable detail in today's strategy video, or the weekend strategy video, covering the pound pairs, because I think the pound has serious potential going forward, at least over the next 2 weeks. So you can check that out if you want to look a little bit more in depth about the British pound. I am also watching the high-yield yen cross as the Kiwi yen has just accelerated. All right, we've seen a very big drop after that break of this rising head and shoulders neckline here. That was a perfect technical setup. All right, now if I were to trade these technical setups, breaks on necklines, consistently over time, we wouldn't be doing very well. Why? Because we haven't seen much of the impetus for follow-through. But the Kiwi yen has played out very nicely, and that's due to specifically the New Zealand dollar. Now, Thursday evening's strategy video was based specifically on one of the considerations I suggested is why the Kiwi isn't dropping, considering that they are, or the market is essentially pricing in a full probability or full 100% probability that they will hike rates in March. All right, you can check that video out to see a little bit more about it, but it's because of interest rate expectations. All right, the market was already pricing them in. 100% probability of March does not necessarily mean all that much if we were already pricing that in ahead of time. All right, but this is pretty significant. CAD yen is slowly trickling lower. The CAD is not in a good place. The Aussie yen has held, but it's not making the progress that the Kiwi yen is making. This is an interesting one as well. All these pairs have great options. All right, they're great setups if we can get the risk aversion theme going. All right. Outside of the risk aversion theme, monetary policy is a more active driver, and this upcoming week's docket is certainly lined with more than its fair share of catalysts for relative monetary policy expectations. All right, so interest rate expectations, taper expectations, rate hike expectations, plenty of that going around. Even some of them that are expected to expand their stimulus program, like the Bank of Japan to some extent, and the ECB. Now, I'm going to separate this into essentially four major currencies that we should be on interest rate watch with. All right, or monetary policy watch. We need to watch the dollar, we need to watch the euro, we need to watch the pound, and the Aussie. All four of those currencies are going to see a very substantial update in data terms or monetary policy terms outright, and that can give us a lot of momentum, especially considering what progress we've made on many of these pairs, specifically because of monetary policy. All right, so let's talk about the dollar. When we look at the dollar's performance this past week, we did have a nice bounce, finally breaking this wedge formation and sticking with the larger technical pattern, a rising channel here. All right, that is the path of least resistance, and overall the dollar is in a great position. All right, what happens to the dollar if risk aversion kicks in? All right, when risk aversion kicks in, volatility picks up. Put that against the FX volatility index, thereby the dollar does very, very well when we're talking about a risk aversion theme. So there's always that option. If the SP 500 drops apart, the dollar is going to look great against most of its counterparts. All right, the more severe the risk aversion theme, the greater the dollar's backdrop. All right, so that's going to be one consideration. The other consideration is that we are tapering. We've tapered twice, all right, consistently. And the market's expectations are for steady tapering through the coming 5 or 6 meetings and essentially taking us down to zero, ending QE3 effectively. That is an initial view of eventual shift towards rate hikes. All right, and interest rate forecasts are a big component of a currency's performance. Just look at the British pound. That pound has rallied for 6 or 7 months, and it's largely on the basis of an interest rate hike expectation. All right, so we are starting to see these interest rate forecasts rising, and as I said yesterday, you can see here the 12-month interest rate forecast is actually at its highest level we've seen since, I believe, May 2011. So things are really starting to improve, and they're improving at a time when the outlook for others is starting to deteriorate. So a good catalyst for conversation about rate speculation. You have a number of data points for the U.S. dollar. You have manufacturing activity. This is actually going to be quite important, the 3-month to 6-month bill sale, because we have a looming, once again, budget deadline. We have policy officials in spades. We have economic confidence figures. Actually, the budget and economic outlook from the CBO is going to be quite newsworthy. We have the ADP employment figures, and of course, when we have the ADP employment figures, that precedes the U.S. non-farm payrolls and unemployment rate. Big data. All right, this is going to more likely have a bullish bias. The market's going to be looking and more responsive to positive outcomes, and positive outcomes mean taper and U.S. growth when the rest of the world is unstable. That makes the U.S. financial markets that much more attractive. All right, so we will be watching the dollar and its inherent bullish bias. So if things remain steady and we see this data, it's more likely that the dollar drifts higher. You have a risk aversion theme, dollar's going to get higher a lot quicker. Now we put that against something like the euro. All right, the euro has seen a substantial drop-off into the end of this past week. We just looked at the euro-yen, and it had that precipitous fall into the close. The euro-dollar, which I was already short, and I trailed up the stop on the second half of my position, is making further progress. Now, I said I'd add to a break to the downside below 135. I am very interested in doing so. However, I've not moved my position back up to full size or added to the second half of the short that I currently have on, because it's the end of the week. All right, it's not something I want to add to into the end of the week. You never know what's going to happen over the weekend, and this is not necessarily a full-blown trend. Risk aversion, once again, really good bearings for the dollar. Risk aversion, not so good for the euro. Right, something that we can see well even on something like the euro pound. So this is a good bearing from that high-level impact scenario, but even the standard approach, the relative monetary policy view, is good for the Euro-USD to the downside. Now, I've been talking a lot about the relative position of these currencies, and we've even made a couple videos specifically on it. But I still want to point out the Euro-USD versus the 12-month interest rate forecast between these two currencies. That is quite remarkable. That is a huge deviation. All right, the Fed is expected, it's moving up its interest rate expectations well ahead of its ECB counterpart. And that's interesting because the ECB's balance sheet is actually being worked down. It has been worked down since the LTRO payment and repayment started last year. So you are seeing a very large deviation, a fundamental gap, if you will. And this is going to be something that can easily play to a much larger correction to the downside. So I'm going to be watching this euro dollar, one of my favorite fundamental trades going forward. Now, we can also watch, or in terms of euro-based pairs, the euro pound. All right, this one will have a lot of influence specifically from the euro if the euro starts to drop off. As I said, I really like the euro yen. You add the euro and you give the euro more reason to drop, and the euro yen will look good. Euro kiwi and euro aussie are also pairs to watch, but they're not necessarily as straightforward, so we'll keep them in the hopper. But what are we going to be watching in terms of event risk for the euro next week? The ECB rate decision. Right? The market is kind of confused about whether there's going to be an upgrade from the stimulus perspective, because the ECB did indeed cut rates at its November rate decision, but the market was expecting more stimulus, specifically like an LTRO program, to thwart or offset particular problems that can arise going forward. And we're already starting to see some of these concerns spilling over. The inflation figures we just had updated through Friday. The headline inflation hit a new record low. The core inflation ticked higher ever so slightly, but it is still exceedingly low. All right, and the interest rates that we get because of that are going to hold low as well, but they are starting to pick up. All right, and the concern is that these interest rates rise, these short-term interest rates, the lending issue in the Eurozone, which is already a problem, is going to further be exacerbated. And the very fragile recovery is going to face some serious problems in the future. So there's a reason, a need, that we can argue a easing or expansion of stimulus by the ECB. Will they take that seriously? We will have to see on Thursday. All right, we'll be covering that one live. I believe Chris Vecchio is actually going to be covering both the BOE and the ECB rate decision back to back. Now, speaking of the BOE rate decision, I won't go too in depth about the pound because it was the topic of the strategy video, but I think it has great potential. The market's expectations for interest rate for the Bank of England have gone to extraordinary lengths. The pound has gained against nearly, or actually all of its major counterparts, and subsequently it has gained substantial ground. Not just it advanced aggressively. All right, and that's a lot of strength for a currency that does not necessarily offer much in the way of yield now. And even if it does fulfill the most optimistic view of the market, it won't be offering us much of a buildup of an interest rates later down the line. So the market's priced in a lot, perhaps too much, most likely too much. If we see the data that's coming down the line in the week leading up to the BOE rate decision on Thursday, like the manufacturing service activity, like the trade figures, all right, that can wear away the sterling bull's confidence and help lead to a break for the pound dollar. I mean, watching this particular setup very closely, all right, because we're seeing a taper, which is proactive, and we're seeing an interest rate forecast for the Bank of England, which actually the Bank of England is trying to push back against. We're unlikely to actually see any kind of change in monetary policy from the Bank of England this coming week, but the following week we have a quarterly inflation report. That's where they're going to update their forward guidance, and they're going to try to salvage their very quickly fading market appreciation. All right, the market is essentially weighing their credibility down because it does not believe that they can stick to their targets for unemployment, because we're almost already there, and subsequently their projections that they'll be able to hold off on a rate hike until 2015. Something has to be resolved, and I have a very sneaking suspicion that it's going to be the market that's going to have to resolve to the central bankers. All right, so we'll keep an eye on the pound dollar, and we'll also keep a very close eye on the pound kiwi. I took a short in the pound Kiwi into Friday morning, Thursday evening, and I was playing this triple top and also this wedge top. Now, as you can see, the Kiwi's big drop-off, which we saw in the Kiwi yen, pushed us a little bit above there and hit my stop. I still think this has great potential. One, because the New Zealand dollar yield is much higher than the pound. The yield outlook is much better for the Kiwi, and the pound is generally overdone. All right, this has great technical bearings, great fundamental bearings. We'll see if this actually makes a leg lower into next week, and if it does so, I'm going to look for a technical break to get back in on a short. All right, but this is another pound pair that I think has good potential, alongside, of course, the pound yen, which we talked about before. Now, the last currency that I do want to keep you attuned to is going to be another relative monetary policy update. With the Tuesday RBA rate decision, all right, we're going to see a update on market expectations for the Aussie benchmark lending rate. Now, the market is still somewhat expecting a rate cut sometime in 2014. That's a bit aggressive, right? Nevertheless, the market is weighing on the Aussie dollar and the belief that there is indeed going to be a cut. All right. Now, if we see that this rate decision comes out to more neutral language, we don't need to see initial rhetoric about a upcoming hike at the end of 2014 or anything along those lines. We just need to see a neutral shift, because a neutral shift would be more hawkish in the scale of things than what the market is currently accounting for. All right. So if we come up to this piece of event risk and the RBA delivers something that was more neutral, be very cautious about what the Aussie dollar is going to do. All right, you can see potentially a good rebound on pairs like the Aussie dollar or the Aussie yen. Of course, my interests are not going to lie there too much, because they are high yield potential, and they're very, very sensitive also to risk trends. So if risk aversion kicks in, but the RBA is a little bit more optimistic, those are going to be competing themes. If I'm looking for an Aussie dollar looking better and getting away from risk trends, pound Aussie does much better on that front. All right, and there's a long-term 38.2 fib that we're facing up there, has good potential for reversal, and as you know, I have problems with the pound. The Euro Aussie is of similar cut. All right, so that one will be in the list. But if you want to get further away from risk trends, keeping a close eye on the Aussie Kiwi, which is making a great bid after this reversal here from this multi-decade low, this multi-range decade low. For those that read the Daily FX Trading Opportunities for 2014, this is one of my two top trades, and it's starting to play to its rebound. And the Aussie CAD, which has been extremely consistent in its back and forth of recent days and weeks. This is also starting to have a series of higher lows and a range top. Could very well get a break back towards parity, and then above that previous swing up at parity plus 30, parity plus 50. So there's a lot of opportunity from the RBA. There's a lot of opportunity from the round of central banks that we have coming up. There's also a lot of opportunity for risk trends. In the scale of importance, relative monetary policy is going to be a more consistent mover, but it's going to be a little bit more slower of a mover, unless we get to the event risk, of course. The thing that has the most explosive power, though, will always be risk trends, especially when we are so heavily skewed to one side with risk. If these benchmarks start to fall apart, the leverage that has been built up behind these positions will start coming down, and when it comes down, it will fuel a very big fire. All right, so we'll keep that concern in the back of our mind, but in the meantime, look to what's moving, and relative monetary policy and small bouts of volatility in the capital markets are certainly enough to place trades on. I hope you guys have a fantastic weekend, and we'll update you once again on what's happening in the markets on Monday.